All right, we want to be respectful of everybody's time, so we will go ahead and get started. Thank you guys for joining us for our September market update. Tonight's format will just be a quick introduction, and then Mark is going to give a brief market update, current news and events, and then we will turn it over to you guys for a live Q&A. So I will come back on and give you guys the instructions on how to specifically ask your questions and do all the functions on the computer. So as you might notice right now, you are all on mute, and I will hop back on and tell you how to get off of mute and ask your question here in a few minutes. One other disclaimer I want to make is that this is being recorded. We will upload it to our YouTube page for anybody who wasn't able to hop on tonight, so that they can still see the content and, ask questions, send in emails and everything like that. So without further ado, I will send it over to Mark McEvely, Chief Investment Officer of Jessup Wealth Management. He'll give you a brief market update.
Thanks, Jenna. Hi, everybody. Thank you again for joining us on our fourth monthly market update webinar. Again, the purpose of the webinar series here is for us to convey our market outlook in real time and give you all the venue to ask us questions that you have on your mind. So tonight I'm joined by Taylor Ledbetter, one of our wealth advisors here at Jessup Wealth Management. Taylor is one of our in-house financial planning specialists. So at the end of my little spiel surrounding financial planning, please feel free to direct some questions to Taylor and she will be able to answer them. Quick disclaimer before we get started, just wanted to say that this is not financial advice nor a recommendation to buy or sell any investment products, and this is meant for educational purposes only. So I'm going to go ahead and share my screen, and Jenna, just give me a thumbs up if you can see that okay.
Looks good.
So just starting out, everybody, obviously, August wasn't the month that we had all hoped for in the markets, coming off of a really strong month of June and July. And kind of in my opinion, I think that there were really two things that sent markets lower during August. And number one was the S&P 500 tagging its downward sloping 200-day moving average on August 16th. So, when we talk about uptrends, or commonly otherwise referred to as bull markets, and downtrends, commonly known as bear markets, the 200-day moving average is kind of a widely used metric to let investors know if we're in an uptrend or a downtrend. So as you can see in the screen right now, the S&P 500 has spent most of 2022 below the 200-day moving average. And you can see there right on, kind of August 16th, we bounced right off of that downward sloping 200-day moving average. And that's kind of when the precipitous fall continued for the markets. This was a big level back in the middle of August that investors would have liked to push through to continue to move higher. And as you can see, the latest rally stalled out right at that 200-day moving average. So until we reclaim that level, we're still in a downtrend and we should expect more volatility. Looking back at history in the markets, the largest up days and the largest down days have always historically occurred under that 200-day moving average. So we could expect some more volatility here before we get through the month of September. And I'll be talking about that a little bit here in a bit. And then I mentioned, that there were two things, in my opinion, I thought that sent markets lower in August. And the second thing was the speech given by the head of the Federal Reserve, Jerome Powell, on August 26th. So, sorry, I just had something pop up on my screen. Powell was very direct with his words and conveyed that the Fed is committed to raising interest rates further, even if we see inflation numbers start to roll over. And investors, I think, were expecting the Fed to pivot and not be as aggressive as they initially thought with interest rate hikes throughout the rest of the year and kind of into 2023 as well. So, but really from our vantage point, nothing that Powell said in his speech surprised us. So, we should expect interest rates to move higher throughout the end of the year, as the Fed has, continuously said that they're committed to doing whatever is necessary to tame inflation and get it back to their 2% target. So next, I just want to talk about 2022 a little bit. And, pretty much the whole year has been, no doubt, kind of the most frustrating investing period for quite some time that all of us can remember. So since the great financial crisis, most market corrections have been swift and quick, which led to recoveries to all-time highs in really no time relative to history. And I think this has kind of led investors to think that the market always recovers quickly, because it has over the past decade. But I think this is kind of an important timing aspect to point out, is that we have to remember that the average bear market since 1933 has lasted approximately a year and a half. So in the chart on the screen, the red shading highlights bear markets and the blue shading is highlighting the bull markets. And I want to point out, look how much more the market gains during bull markets than it loses during bear markets, and how much longer bull markets last than bear markets. And as long-term investors, we have to keep this in mind looking forward to make sure we're taking advantage of having that long-term mindset when it comes to investing in the markets. I think sometimes too many people worry about protecting against declines that sometimes they forget to position themselves for the good times, which, as we can see, in this chart above, is the majority of the time. So I know that 2022 hasn't been very fun from a return standpoint, but I do think we are getting towards the tail end of this. And this kind of leads me to my next point, which we have kind of shared with clients several times throughout 2022, and that has something to do with the 4-year presidential cycle. So the second year of the 4-year presidential cycle, which is otherwise known as the midterm year, it tends to be the weak spot out of the 4-year presidential cycle. And specifically, the first 3 quarters of the midterm year tends to be extremely weak. And that's exactly what we've seen so far this year. So the last midterm year, for example, in 2018, the S&P 500 was down more than 6% for the year. So we're really at the tail end of this weak spot for the presidential cycle, which means we're about to embark on the sweet spot of the 4-year cycle. So the sweet spot tends to run from Q4 of the midterm year through the first half of what we call the pre-election year, which in our case would be in Q2 of 2023 next year. And when looking at this chart, we really have to ask ourselves, do we really want to be on the sidelines when we're entering the strongest part of the 4-year cycle on a seasonal basis? And, my answer is, just looking back at history and using it as our guide, we don't want to be positioned too conservatively, because typically Q4 alone, just in general, has been stronger than average for the S&P 500. And I'll throw that chart up here for everybody right now. So as you can see, this is the S&P 500's average return since 1950 by calendar month. And is it always going to play out exactly what history has shown us? No, absolutely not. So for example, you can see that April is one of the strongest months out of the year in the S&P 500, but April was pretty weak this year. But as you can see, the last 3 months of the year tend to be pretty strong, and especially in midterm election years like we're in right now. So just wanted to kind of give people some context as to why we think we're kind of on the tail end of this bear market. Obviously, we have pretty much the whole month of September where a lot of things can happen between now and then. But I think it's important to point out that from a seasonal basis, we're going into a strong period of the year. So the last point that I kind of want to make about the midterm year is that the average midterm year tends to bottom somewhere around August 14th, so a little less than a month ago. The thing that I want to convey is that if you look out 1 year after the S&P 500 bottoms in a midterm year, the S&P is up over 30% on average with no instances of negative returns, and that's a year later. So like I said, this just aids to our bullish thesis going into the end of the year. And the guy that presented this chart, his name's Ryan Dietrich, one of the highly respected analysts that I follow very closely, I think said it best. He said, bottom line, midterm years are usually aggravating and troublesome, which this year has been, but the future can indeed be bright. So, with that being said, I kind of want to wrap up with a brief update on the economy, just because I want to be respectful of everybody's time. I wanted to make this brief and to the point. Inflation is rolling over, in our opinion. Commodity prices, including oil, lumber, cotton, wheat, copper, iron, they've all fallen drastically from their highs. Another example, domestic auto inventories are up from their lows and prices are well off their highs. Obviously, there was a huge shortage of automobiles in the country because of the shortage in semiconductors going on globally. That is beginning to resolve itself. The consumer price index is falling month over month, and future estimates of the consumer price index continue to come down. And the same is true for personal consumption expenditures index, which is the Fed's preferred gauge of inflation. Home prices have declined the most since 2011. Mortgage applications have dropped to low levels not seen really since the late 90s. The total number of people quitting their jobs is off of the highs seen in 2021. So the labor market remains extremely resilient through everything that we've gone through in 2022. Food prices have dropped to 5-month lows. And we're optimistic that these inflation numbers are going to continue to get under control over the next year or two. And we do truly believe we're headed in the right direction. But as always, I think it's important for us to be aware of the risks in the market. And, not saying this to, put out theories out there or to scare anybody. And I think this is worst case scenario, but I think it's important to mention that, in my opinion, the largest risk to the market right now is another unexpected jolt to the global economy that we just can't sustain. So think previously of COVID and then the unprecedented monetary stimulus, and then which brought on this inflation storm that we're dealing with right now. I'm not sure how much more the global economy can handle at this point. So the thing I just want to point out is that there's just not a lot of slack left in the global economy right now. And I think we need a period of 1 to 2 years where we see calmness. But, to the flip side of that, we can't invest based on fear or based on what could happen in the future. No one truly knows what's going to happen in the markets and especially in the economy over the next week, month, year, even 5 years. I wish I had that crystal ball for everybody, but that's just reality. But we do know the market moves in 2 steps forward and 1 step back. And we believe we're on the tail end of this quote unquote 1 step back that we've experienced in 2022. And we do think the future is bright. So with that, I want to turn it back over to Jenna so she can open it up for any questions. So anything related to the markets or the economy, please feel free to ask me the questions that you have, because I'm sure if you have a question, then somebody else has that as well. And again, any financial planning related questions could be directed towards Taylor Ledbetter. So Jenna, I'll turn it back over to you.
Yep, just a few things just to help navigate the Q&A. If you are on a desktop and you'd like to ask a question, you'll go down to the bottom of your screen where there is a reactions button, and then you'll just click the raise your hand figure. And then I will prompt to unmute you, and then you can ask your question. If you're on your phone, you'll go down to the bottom of your screen where there is the same reactions button. You'll click your name, and then you'll click raise your hand, and I will then prompt to unmute you. So at this time, if anybody has any questions, feel free to raise your hand and ask them.
And that's okay if we don't have too many questions, because I know there isn't a whole ton of people on here. But again, this is being recorded, so for those of you who tune in after Jenna posts this online to our YouTube page and our social media sites, and you have a question that does come up, feel free to send that to Jenna, and we'll go ahead and get in contact with you to get that answered. Or we can start a log of listener questions that come in and start to answer those at the beginning of every new monthly market update. So, all right. Well, it doesn't seem like that there's any questions tonight. You guys are making my job easy. So thanks everyone for tuning in tonight. Again, if any questions do come up over the next several weeks or over the next month before our October market update, feel free to contact us and we can chat and get your questions answered.
All right. Sounds good.
Thanks, everybody.